Knowing basic budgeting is crucial for both households and businesses in making financial decisions and strategical investments, with the goal of giving yourself headroom to be prepared for the opportunity you are waiting for or that you think might come in the future. What are the priorities needed to be attended to, and how do they help you position favorably for success? Let's look at it in today's episode. With a couple of good years between every global economic crisis hitting us, it is important to go through the theory of personal finance from time to time to make the most out of the good times and brace for the bad ones. If not for expanding on your knowledge about budgeting, for repetition of already learned knowledge, or for adding and expanding on the subject in the comments, hopefully there is something for everyone in this video. We will deepen the topic in the coming episodes in this playlist. While some of us have the good fortune to be able to relax more during prosperous times without stressing about surviving financially, not all have it so well that the same is true during hard times, either collectively on a global scale or individual hard times. In those times, we might need to really dial in our budgeting skills to match our current circumstances. Timing is a factor that is hard to predict, which make us have to make decisions on assumptions. Through human history, we have wanted to make sense of our existence by different means. One of the tools that helped us out was logic. By structuring and organizing our understanding of the experienced, we were able to categorize, sort, and register almost everything we could perceive. This creates the foundation for us to do research and create concepts by clarifying, overviewing, mapping out, and clustering data for easier pattern recognition, trial and error testing, or any other scientific method. These ideas are also usable in other areas as well. An older study about mental budgeting and consumer decisions from 1996 shows that budgeting may lead to underconsumption. The budgeting effects are larger for purchases that are highly typical of their category, reducing the amount spent in that category and blocking the purchase of other typical items, suggesting generation of two kinds of labels. First, money as relevant for a certain class of goods, and second, labeling the goods as relevant for a certain pool of money, calling them the budget setting and the expense tracking processes. For a budget to be an effective self-control mechanism, it must be somewhat inflexible. If allowed to reallocate at a whim, temptation might undermine the plans. However, the inflexibility comes at a cost. Missing opportunities that might arise, such as offers on things that would be purchased either way, but now at a lower cost. Budgeting too low might lead to underconsumption on things that you really want. Too high might lead to overconsumption of things of less desire. Missing optimal satisfaction in budget. This goes against classic theory of the economic consumer as rational and always consuming optimal quantity of each good. To summarize, when budget is too low, consumers will avoid buying goods in that account even though they are not tired of it, satiation, and even though they do not lack money to consume it, income. On the other hand, if there is room in the category, a price fall might lead to overconsumption instead. In the expense tracking part of the budgeting process, typical expenses will be easier to book and post than less typical expenses. Combining the two parts of the process, prediction is that typical goods will be more subject to budgeting constraints than less typical. Due to particular goods being more likely to be posted to their expense accounts, they will affect budgets much more. There is risk of doing some mental gymnastics to justify a certain purchase, like when we categorize it as an investment and not a purchase of satisfaction. A study from just before the end of the century, in December 1999, summarizes the knowledge about the topic of mental accounting over the last decade, describing mental accounting to being the set of cognitive operations used by individuals and households to organize, evaluate, and keep track of financial activities. Three components violate the economic principle of fungibility and influences choice. How outcomes are perceived and experienced, and how decisions are made and subsequently evaluated. The accounting system provides the inputs to be both ex ante and ex post cost benefit analysis. The assignment of activities to specific accounts, both the sources and the uses of funds, are labeled in real as well as in mental accounting systems. Expenditures are grouped in categories, and spending is somewhat constrained by implicit or explicit budgets. The frequency with which accounts are evaluated and choice bracketing. Accounts can be balanced daily, weekly, yearly, and so on, and can be defined narrowly or broadly. Examples used for how mental accounting works in our daily lives are if a product that comes in three sizes with increasing price tag for each of the bigger items, and all of them are at the same price during a sale, we might choose the bigger one even though we don't actually need it, but the saving is bigger. Transactions are often evaluated one at a time, rather than in conjunction with everything else. The difference between $10 and $20 seems bigger than the difference between $1,000 and $1,010. Losing $100 hurt more than gaining $100 yields pleasure. Many are more willing to save $5 on an item by traveling longer if the item costs $15, less willing if the item costs $125. Many consumers seem to value a flat rate service over measured service, even when the bill they would receive would be the same. We don't like the feeling of having the meter running. The impact of paying $50 in cash compared to adding it to the bigger credit card bill is very different in how we perceive the size of the $50, especially if the credit card bill is not paid in full but divided. Budgeting categories serve two purposes. It can facilitate making rational trade offs between competing uses of funds. It can also act as a self control device by keeping spending within the budget. As a rule, the tighter the budget, the more explicit are the budgeting rules. Households near poverty level use strict, explicit budgets. Wealthy families' budgets are both less binding and less well defined. Poorer also tend to have budgets defined over shorter periods, week or month, whereas wealthier may use annual budgets. Expenses must be booked, recorded in the accounting system, and posted, assigned to a specific expense account. Many small routine expenses are not booked. Some are divided monthly and thus only register as small daily expenses. Households who contribute to retirement savings plans display steady increases in the funds in these accounts, with no apparent reduction in the funds in other accounts. Those asked how to invest retirement money chose bonds when shown 1-year returns and stocks when shown 30-year returns. A study from 2002 about building a practically useful theory of goal setting and task motivation summarized 35 years of empirical research on goal setting theory. The highest or most difficult goals produce the highest level of effort and performance. Specific, difficult goals consistently led to higher performance than urging people to do their best. In short, when people are asked to do their best, they do not do so. This is because do your best goals have no external referent and thus are defined idiosyncratically. This allows a wide range of acceptable performance levels, which is not the case when a goal level is specified. The force to act is a multiplicative combination of valence, anticipated satisfaction, instrumentality, the belief that performance will lead to rewards, expectancy, the belief that effort will lead to the performance needed to attain the rewards. When goal level is held constant, which is implicitly assumed by the valence instrumentality expectancy theory, higher expectancies lead to higher levels of performance. The concept of self-efficacy is important in goal setting theory. When goals are self-set, people with high self-efficacy set higher goals than do people with lower self-efficacy. They also are more committed to assign goals, find and use better task strategies to attain the goals, and respond more positively to negative feedback than do people with low self efficacy. Goals affect performance through four mechanisms. They serve a directive function. They direct attention and effort toward goal relevant activities and away from goal irrelevant activities. The effect occurs both cognitively and behaviorally. Goals have an energizing function. High goals lead to greater effort than low goals. Goals affect persistence. When participants are allowed to control the time they spend on a task, hard goals prolong effort. There is a trade off in work between time and intensity of effort. Faced with a difficult goal, it is possible to work faster and more intensely for a long period. Tight deadlines lead to a more rapid work pace than loose deadlines. Goals affect action indirectly by leading to the arousal, discovery, and or use of task relevant knowledge and strategies. When combating performance anxiety, set specific, challenging learning goals, such as to discover a certain number of different strategies to master the task. Commitment is most important and relevant when goals are difficult. Two key categories of factors facilitate goal commitment. Factors that make goal attainment important to people, including the importance of the outcomes that they expect as a result of working to attain a goal. Their belief that they can attain the goal, self efficacy. There are many ways to convince people that goal attainment is important. Making a public commitment to the goal enhances commitment, presumably because it makes one's actions a matter of integrity in one's own eyes and in those of others. Goal commitment can also be enhanced by leaders communicating an inspiring vision and behaving supportively. People who participated with others in formulating task strategies performed significantly better and had higher self efficacy than those who did not participate in formulating strategies. It is possible to raise self efficacy in peers and subordinates by ensuring adequate training to increase mastery that provides successful experiences. By role modeling and finding models with whom the person can identify, and through persuasive communication that expresses confidence that a person can attain the goal. The latter may involve giving information about strategies that facilitate goal attainment. Transformational leaders raise the efficacy of employees through inspiring messages to and cognitive stimulation of subordinates. Summary feedback is a moderator of goal effects in that the combination of goals plus feedback is more effective than goals alone. Motivation requires feed-forward control in addition to feedback. After people attain the goal they have been pursuing, they generally set a higher goal for themselves. Students who set specific high goals regarding their evaluation by peers and who received training in verbal self-guidance regarding goal attainment had higher team playing skills than those who did not set goals. People have the power to actively control their lives through purposeful thought. This includes the power to program and reprogram their subconscious to choose their own goals, to pull out from the subconscious what is relevant to their purpose and to ignore what is not, and to guide their actions based on what they want to accomplish. A study from 2004 that looked at American retirement savings highlights the difficulty for households to make rational and optimized decisions when budgeting. Assumption is that households want to smooth consumption over the life cycle and are expected to solve the relevant problem in each period before deciding how much to consume and how much to save. Reality is that it is difficult to compute the correct saving rate. And even if it is known, the self control might fall in reducing current consumption in favor of future consumption. Changes in firms' retirement plans require a higher amount of engagement in selecting the saving rate. Saving through pensions made a lot of difference on the degree of freedom when retiring. By using a program called Save More Tomorrow, workers committed to increase savings rate later each time they got a raise. Reasons given for low saving was lack of self-control, bounded rationality, and procrastination by those who had the intention to save and expressed that the current saving rate was low. Another explanation might be that loss aversion affects savings once households get used to a particular level of disposable income. They tend to view reductions in that level by increasing the saving plan contribution as a loss. This is further understood as our experience of loss and gain is in nominal currency. Referring to another study about fairness, some subjects did not think it fair to receive a pay cut, but a raise that was below inflation was deemed as better, a type of money illusion. One successful factor is inertia when starting a plan, which helps sticking to it as it takes more effort to opt out. A study from 2013 looks at the importance of financial literacy by studying theory and evidence. Increasingly accessible financial markets have added to the toolkit of credit card and subprime mortgages, payday loans, pawn shops, auto title loans, tax refund loans, rent to own shops, and so on. Less financially literate were substantially more likely to use high cost methods of borrowing, particularly strong among young adults. Investment in financial knowledge appears to be a specific form of human capital rather than being simply associated with more years of schooling. Financial knowledge impacts key outcomes, including borrowing, saving, and investing decisions not only during the work life, but afterwards in retirement as well. Important benefits of greater financial knowledge include savvier saving and investment decisions, better debt management, more retirement planning, higher participation in the stock market, and greater wealth accumulation. A study from 2014 conducts a meta analysis of the relationship of financial literacy and of financial education to financial behaviors. Variances in behavior could not be explained through interventions to improve literacy, and educational ones had negligible effects 20 months or more afterwards. It argues that just in time financial education might be more effective if tied to particular decisions, as there must be some immediate opportunity to enact and put to use, or it will decay. Another study from 2016 looks at the unintended financial consequences of earmarking to encourage savings. People's tendency to preserve savings by borrowing from a high interest rate credit option varies as a function of the savings' intended use. Paradoxically, people are most likely to turn to high interest rate credit with the belief that doing so is the responsible option. Some consumers simultaneously hold large amounts of low interest bearing savings and high interest rate debt. The desire to act responsibly by preserving money in savings accounts underlies costly borrowing behavior. In many situations, labeling savings accounts can be useful as a self control mechanism, leading people to reduce the short term discretionary spending to allow for important long term benefits with no financial penalty. People remained reluctant to spend down savings for emergencies, even when money had been designated specifically for that purpose. A study done in 2019 about increasing saving behavior through age processed renderings of the future self looked at the fact that many people fail to save what they will need for retirement. By looking at present and future selves instead of focusing on immediate and future rewards, we circumvent failure due to lack of belief or imagination. By interacting with a realistic computer rendering of themselves, the participants exhibited an increased tendency to accept later monetary rewards over immediate ones. The associated age of retirement in 2007 was 65 in the US. Expectancy was to live around 16 years in retirement on average. We live longer than before. Also, retirement is longer. We also risk outliving our retirement money. 43% of households fell at least 10% short of reaching target replacement rates. Accounting for financial crisis, it looks dire. Few have the resources to maintain the retirement standards of living in retirement. To people estranged from their future selves, saving is like a choice between spending money today or giving it to a stranger years from now. Sadness leads to more spending, as the decision of how much a paycheck to allocate to a 401k is normally made once and is rarely revisited. The moment a person makes an intertemporal choice is the most important time to consider the interests of the future self. A study from 2022 looked at the budgeting process using a nationally representative survey of adults in the US. Budgeting was highly prevalent across income distribution, even when liquidity was relatively high. This challenges the belief that people only budget when faced with financial strain, though it suggests that negative financial information may discourage people from starting with budgeting. Over 90% of the participating individuals that budget reported doing so using budgetary categories, although there were wide differences in the level of granularity of these. A majority would adjust their spending or update their spending limits if overspent within a budget category, but would not do so if underspending. It is understood as households' budget in order to constrain spending rather than as a means of tracking spending over time. The predominant reason for budgeting was to avoid overspending the income. Other reasons presented were saving for long-term goals, short-term goals, to avoid debt from overspending, to get out of debt, and avoiding debt from unforeseen expenses. The major reasons for why they did not budget in the other group among respondents with low financial well-being was that budgeting made them feel like they have less money than they thought. The lower the financial well-being, the more frequent attention was paid on the budget. The list of categories varied from between 2 items to up to 13 items. The most extensive one was categorized as follows: rent, utilities, cell phone, internet, car, groceries, dining out, movies, travel, clothing, exercise, healthcare, and other. Budgetary slack is defined as being the difference between the amount budgeted and the amount actually spent. The Commonwealth Bank of Australia, CBA, uses 5 components that dictate a financial well-being score from 0 to 100. Payment problems, a measure of the extent to which a customer experienced difficulty making payment. For example, insufficient funds or over-limit fees, late fees, payday loan usage, and so on, in the past year. Low balance, the number of days in the past year with liquid balances below average weekly expenses. Net spend, the number of months in the past year with spending exceeding 80% of inflows. Expenses covered, the number of days in the past year where the customer had the ability to raise several month expenses from savings or available credit. Relative savings, a measure of a customer's savings, balance relative to their own age. Among respondents that budgeted, nearly 1 in 5 used different credit cards for different types of expenses. A study from 2026 that looked at available research of household finance explains household preferences as important determinants of household financial decisions that can't be observed directly in contrast to other parameters such as age, income, or wealth. Oversimplifying, the preference parameters to be understood as follows: preference for consumption, today versus in the future, and prudence driving saving and borrowing behavior. Household risk aversion drives investment and insurance decisions. The literature on co-holding puzzles shows that complex nature of household debt behavior, the specific actions ranging from cognitive errors to rational decision making that cannot easily be inferred from observational data. An individual might take out a car loan even though having enough liquid assets to purchase a car, so as to finance a vacation for which a loan cannot be obtained. Someone about to retire may hold on to previously obtained loans in order to maintain liquidity that cannot be obtained due to difficulty of borrowing at that life cycle stage. Some key results. There are many aspects to consider when thinking about personal finances and their effects on our lives. Today's needs and those of tomorrow both fight for your allocation. At the same time, it might be difficult to plan for the future if you are barely surviving today. This might lead us to make wrong assumptions on what tactic that is the optimal one. Knowing how we think and behave at least gives us an opportunity to intervene or circumvent bad decisions and manage to balance a bountiful life now and later a pleasant retirement. Some anecdotes. Learning to properly budget was a skill that I paid little attention to during a long time, as it is commonly understood to be necessary but dull. No fun at all. Though there certainly are some groups of people who like spreadsheets. The reasoning might be the same as when cleaning, the satisfaction of seeing the end result, not the actual cleaning or budgeting. Though some might find peace doing it as well. A sense of control. Anyways, today I feel some sort of joy about knowing how my money flows and seeing progress according to my goals and plans. As there are several reasons for why it is a good idea to understand your financial situation. The compounding effects on your psyche, if positive, can help you reach not only financial plans but also regain a sense of self control when goals are met. If your situation is stressful, you might feel a strong urge to stay blissfully unaware, live day to day, and never really know if you will have enough to cover next month. Any emotional state we are in affects every other parts of our lives. Some limitations. This topic is as vast and diverse as there are households and businesses around the globe. There is not one template that fits all. Use the methods and tools that make the most sense to you and your current situation. One of the most important aspects of working with budgeting is to do it in a sober and honest way, even though you might dread the result. If it risks exposing what you fear the most, that you are in a bad situation that is unsustainable, the first step is accepting that you are in bad shape so that you can start working towards a solution in a structured and methodical manner. So, what do we think here at Almir? For the sake of preparedness and to position yourself in a stable and independent way, most of us would benefit from understanding and proactively working with budgeting. The less disposable income we have, the more crucial it becomes. Obviously, budgeting is the most important thing for anyone who's barely surviving financially. The more burdened we are due to interest rates, amount of people to feed, or lifestyle creep, the more there is to gain by being brutally honest with the calculations and give you a chance out. Some limitations. It would be dishonest to talk about personal finance merely from a logical and numerical perspective without touching the emotional and psychological aspect of our relationship to what currently powers human societies. A lot of human emotions and states of mind can relate to how our financial situation looks and is interpreted. Empowered when successful, shame when not, anger when others succeed, or empathy for those with less. It is not only numbers that dictate our misery, as we can have much resources but be in a scarcity mindset or compare us to those who have even more to feel inferior still. Some actionable advice. Start budgeting if you haven't already. If you already are, optimize it with your future self in thought. What type of life do you think you will want to live when older? Pay off high interest debt. Save for unforeseen expenses. Save for a trip. Invest money to let it grow. Give yourself a shot at greatness. Invest in yourself, education, experience, and practical sound financial budgeting. Learn about the options available in your region and in reach for your financial situation. If not available to you yet, plan for how to make yourself eligible. Treat your credit score with respect and do what is necessary to position yourself favorably for when you will need the loan for a house, education, or investing. Learn to budget properly by looking up courses or tutorials. Make sure to understand interest rates, saving compounding interest, forms of investment, and the optimal way to diverse your money to protect your wealth. Balance ways to increase your income with tactical frugality to keep your balance in check to succeed with your financial plans. Secure a day job, start a side business, invest, Find like-minded people to share tips and cooperate. If you're just trying to survive right now, do whatever you need to. Point out a reachable financial goal within 1 year. Break it down and plot out the steps necessary to reach each part. Make daily, weekly, and monthly financial progress. Small steps that take you one step closer each week. Either mentally, practical, or monetary steps. Setbacks are a reality. Count them in your plan so you don't get surprised when they show up. Conclusion: peace of mind and freedom, higher financial well being, equals less engagement by needing to check the budget less often. To know that there is no sudden expenses that lead to you not being able to pay your bills and live the life you want. No matter where you are in life, this is one of the best gifts you can give your nervous system and health in both short term and long term. Be active in your financial journey. We don't have a say in where we are born or under what circumstances, but we do have a say in how we confront life and all the shit thrown at us. Decide on a goal. Position yourself on stable ground first. Start making small steps, then bigger ones, until you are sprinting and money takes a backseat when you are busy living life. The goal is to not have money guiding your daily life. It is meant to be a tool to facilitate our modern lives. When your nervous system stops being on high alert, when you start feeling well rested after a good night's sleep, when you start noticing the light and warmth of the sun, the birds singing, when your body is restless and asks for adventure, then you will finally understand how beautiful and exciting life is supposed to be. Go get the life you deserve. If you want to support us, you can try out our Almer app. You will find it on either app store. If you want to support us in other ways, you could join our community forum. You could also like and comment on this episode or even subscribe to the channel. That will help us a lot. Take care of yourself and your people. See you in the next episode.